The markets have been relatively calm for the month of May. But if you dig deeper and look under the hood, there are opposite forces at work. And as if the force that wins will really determine which way the market goes from here. Greetings, viewers. You're watching Aman Sanga, independent financial advisor in Mississauga, Ontario. For my update for the month of May, I will be touching upon the following four topics. I'll start with where we are in vaccinations, especially here in Canada. I'll briefly touch upon the index returns. Then I'll go upon the topic that has been top of the mind, which is the inflation, whether it's going to be transitory or it's going to be permanent. And lastly, I'll talk about portfolio positioning, especially in the context of where the valuations are of S&P 500 versus the rest of the world. So let's get started with the first, which is the vaccination drive. Now, vaccination drive is on worldwide. In Canada, we have largely caught up when it comes to the first dose of the vaccine, but we are far behind when it comes to the second dose. So there's a lot of work to be done, and hopefully in June, July, and August, we can be at a point where we can break out of this vicious circle of going into lockdowns again and again every couple of months. So really looking forward to a hopefully normal fall of 2021, keeping fingers crossed there. With that, I want to move on to the next topic, which is the index returns so far year to date. The story clearly is a TSX story, strong returns, and the other story accompanying that is the rise of the Canadian dollar, which is likely to continue a little bit more. Now, the other indexes have also had a good return, but when you bring them back into Canadian dollars, given the growth we've had in the CAD, those returns don't look really that impressive. And just before I move off, gold is largely flat for the year. Same way as the theme for this, it's looking for direction as to which way it goes from here. So I talked about the markets being flat in the month of May. Now, if you look at the S&P 500, it's relatively at the same level where it started the month, and the volatility, if it's very low compared to where it was in earlier part of the year. So it doesn't mean that there's nothing going on. I mean, there is a lot going on here, and the big story has been the inflation. I mean, the numbers on a year-to-year basis are definitely high, but it's a bit understandable also because as the demand gave way due to the pandemic, there was a downward pressure on the prices. So we are coming off a base which was really low. So in that sense, it doesn't strike as unusual. The question is it permanent or is it transitory? So in that context, I look at the other shoe, which is to do with the wages. Now, for inflation to be holding or be permanent, it's the wage inflation that needs to take hold. And in that context, if you look at the unemployment numbers in US, it's almost double of where it was pre-COVID levels. And as the services sector come online, we are seeing a downward pressure on the wage growth. So before I move on this topic, I just want to say that I am of the camp that inflation is transitory, and we need to revisit this when unemployment is at, like we are at full employment in the US. And at that time, we can really say, where this is going to go. But till that time, I stay in the view that this is going to be transitory for now. Now, that's one thing. But the other thing that goes along with is the federal funds rate, or what we expect, what we look forward to from the Fed announcements. Now, the federal fund rate has been at the historic lows that it has been. The only other way downward is negative. But I think Fed might be forced to force its hand just because of the US economy that's expected to grow at 6.5%. Now, a zero rate is reflective of an anemic economy. Economy growing at 6.5% does not need a 0% rate, and the rate needs to be much higher than that. And that, in my mind, is not necessarily a bad thing. We could see the Fed move on this either by taking their foot off the quantitative easing or raising the rates much sooner than what they have previously publicized. And again, as I said, I'm repeating myself, not be a bad thing, because that's really a healthy economy would probably have much higher rates than where they are currently. Lastly, I want to talk about the portfolio positioning. Now, the US has taken on an enormous amount of debt, and the GDP, debt to GDP ratio has jumped from about 100% before the pandemic to about 130% currently, which will take up their resources to service this debt. And which means that we're likely to expect the secular decline of the US dollar in the future, in the years to come. Now, with that backdrop, if you look at the current valuations of S&P 500 versus the other indexes, now it's trading at far higher levels, and whether it compared to TSX or whether we compare it to EFI or whether we compare it to emerging markets. So my concluding thought here is, if your portfolio is US centered, now is really the time to look at it, if to make sure that you have adequate exposure in the other parts of the world. And if you can do it by yourself, kudos to you. If you need help, you know the number to call: 905-363-5035. So I want to conclude by saying that vaccination drives are going to be the focus for the next couple of months. I am hopeful that once the vaccinations are in, the jabs are in people's arms, we will look forward to a resumption of a normal life, which should be good for the world GDP, and that growth is likely to come more out of US and from other parts of the world than specifically from US alone. With that, I want to thank you so much for watching, and bye for now.